Yeah, people get mad about.
We are live. Jason, take us away.
Happy Friday, everybody. Welcome to Pirates of Finance. This is a live show, which means there's always technical difficulties. This is why we're laughing, because mics weren't working and then we're going live. We like to come to you every live at 3 p.m. Eastern, noon Pacific here on the Blockworks channel. We're happy with our home with Blockworks and happy to have Jack, as always, working the ones and twos for Corey and I to Babylon. Once again, this show is with a disclaimer. This is not investment advice. Please do your own due diligence. This show is hopefully for entertainment purposes only. Corey and I have no clue what we're going to talk about. You're going to get just two guys and rant and ramble about what's been going on in their weeks, and hopefully it's at least mildly entertaining for you. With that said, I'm not even sure what our topics of conversation are this week.
Jason,
Corey...
this was a big week.
Okay.
Right? I mean, developments in Russia, Ukraine. We've got triple witching. You had the FOMC meeting, you had a rate hike, and we're going to talk about the most important thing of all, which is ApeCoin.
Nice. I'll let you, with that intro, I'll let you lead off ApeCoin and maybe give a little background for people that aren't, even though we're on Blockworks, that may not be up on
this
ApeCoin.
Is great because I don't even know how to give background to this one. All right, let's see if we can do this for people who aren't in the crypto space. May 2021 was the birth of the Bored Ape Yacht Club, which maybe you've heard of. It is the pictures of the monkeys in different outfits. They're apes. I got yelled at for calling them monkeys. Actually, I think they're apes, which there's a difference there. And they became one of the most popular NFTs out there. I think there's 10,000 total. They then had some creative ways of using them. They created a second set called the Mutant Ape Yacht Club. And owning these conferred certain rights to the holders. There were parties that they were allowed into that were hosted. There have been other giveaways that they've been part of. There have been competitions. And a lot of the talk has been around when is Yuga Labs, who were the creators of Bored Ape Yacht Club, going to create their own cryptocurrency. And because of sort of the high profile of Yuga Labs, they didn't want to do it and violate securities law. So they spent a lot of time conferring with the SEC, figuring out the right way to launch this. And they just announced this week that they were going to launch them and actually launched the cryptocurrency yesterday morning. And owners of Bored Apes, Mutant Apes, or the Bored Ape Kennel Club NFTs were all entitled to claim a certain amount, depending on the number of holdings you had. And so it's actually, I think yesterday I saw the volume in this cryptocurrency was actually higher than the volume of Ethereum traded, which is sort of mind-boggling given how much volume is traded in Ethereum every day.
So you started though with like the logistics of, working with SEC. Is this a security token, et cetera? Correct me if I'm wrong, but to me, it's a form of governance token DAO. It was just for voting rights, or what was the idea?
My understanding right now is it's pure voting rights is how it's been launched. It confers nothing else. There's a bit of a roadmap, and there's actually a couple of proposals that have been put forth that if you hold these tokens, you can vote on whether you want these proposals to go through. Things like the ability to stake your tokens to earn yield, other things. Honestly, I haven't dug that deep into it yet, but there's a whole website dedicated to it. One of the most interesting aspects of this whole experience to me, I actually own a mutant ape, so I was entitled to claim some of these ape tokens, was that typically you see claims and airdrops happen and the tokens are not listed on the centralized exchanges. So you may be able to claim your ape token, but you really can't trade it anywhere unless you go to a decentralized exchange like a Uniswap. But you can't trade it on Coinbase. You can't trade it on FTX. You can't trade it on Binance. Well, it was clear that Yuga Labs actually coordinated very heavily with the centralized exchanges, because from moment one, you could trade these tokens on the centralized exchanges. Not only could you trade the tokens, you could trade perpetual swaps, so derivatives of the tokens immediately, which made things very interesting because there's this sort of game theory of when the claim happens, how quickly will you be able to claim your token? Do you go to try to dump it immediately? If gas fees get completely wild and the blockchain slows down, how do you protect your position? So one of the first things I did was I went to claim, realized I wasn't going to be able to claim very quickly. People had driven up gas prices so much. So I just went to my FTX account and I shorted some perpetual futures as a hedge, locking in the price that I was happy to sell at. And that actually worked out really well for me yesterday. But it was very interesting. Unlike any other airdrop or claim that I've seen so far, it was a very coordinated, well done release.
Let me ask a couple of questions along that. One, like you said, you hedged your risk, but what was the price action? Didn't it go down like 80% in the first 24 hours?
Man, the price action was pretty wild. I wish I had sent Jack a picture of this. So in the first couple minutes, the underlying token, so the ApeCoin, went up to like $40 or $50. Now, for context, like, price is not value, right? So what does $40 or $50 mean? Well, there's a billion of these tokens. So sort of like the total value, total market cap of these tokens at $40 or $50 is 40 or 50 billion, which makes it one of the largest cryptocurrencies out there. But at the same time, the perpetual swaps only went up to about $14. So you had this huge disparity between the underlying and the derivatives. And then what you saw was price just collapsed. They converged to around $10 each throughout the day, fell to about $6, and then actually throughout the rest of the day rallied overnight, went to about $16, $18. I think today it's trading around 13, 14. So that puts the value of this, sort of the total market cap here at about, I think 13 billion.
So, Corey, this I think I just took a screenshot, is of the ApeCoin perpetual futures, which, I don't know what they went live around $10. I think they hit a floor of $6, and there was some crazy price action of the first day. So, Corey, I just want to clarify that for people who don't know. ApeCoin is something that was given to people who owned apes, whether they were mutants or the original Bored Ape Yacht Club. And those things are worth money, and that's the chart that we're looking at right now. And the unique situation, the rare situation we're talking about, is most of the time there's an airdrop. You can sell it on a decentralized exchange, but it's rare to get it on listed, listed on the New York Stock Exchange, listed. Goldman Sachs is trading in it. This time, not only was it listed immediately, but it actually, you could trade derivatives on it, and that's what we're looking at, the perpetual futures.
Yeah, the historical pattern for these sort of things is that there's an airdrop where these things just show up in your wallet, or there's a claim process where you go and claim them. And then typically it takes a while for the centralized exchanges to decide whether they want to add them, right? They need to be sure that this isn't just a scam token. And it takes even longer for them to add perpetuals or any sort of derivative on them. So what you typically see is this behavior of an initial dump, as people just who don't want to own it go, great, I just got free money. So they dump it. And then you typically see some sort of pump until there's a listing event. And once there's a listing event and much more liquidity comes into the system, you tend to then see an immediate dump. So it was interesting, right, to have that immediate liquidity, not just in the underlying spot, but actually in derivatives that allowed someone like me to say, I'm not going to be able to claim this for a few hours, but I've got collateral in my FTX account. I'm very happy to sell this at $10. I think that's overvalued. I'm going to short some of my position to hedge that out so that if this thing does dump, as it did throughout the day, I can sort of have locked in that $10 sale.
I got a few other dumb questions for you. One is, a governance token, right? Correct me if I'm wrong. And by the way, Mazel Tov on owning a mutant ape. But the whole point of the Bored Apes was actually you actually own the IP rights. Now Bored Apes is obviously getting involved with CryptoPunks too, where you didn't own the rights. So if you actually own your ape, you actually had almost full autonomous governance over your ape, essentially, didn't you? So what would be the point of a governance token? And maybe, I don't know, the secondary question to that is, I don't know how much you've looked into it. I know that at one point months ago, they had well over 100 million in the treasury just from secondary sales. So is this also accessing that treasury? But then I would think that would be a security token. So is it accessing or not? And then do you think that this is potentially just a proxy way for people to play, Bored Apes, mutant apes, if they can't actually afford an ape, even though this token doesn't necessarily signify anything? It's like a meme proxy for being part of the ecosystem. So that's the essential approximate value of it.
Yeah, so I'll address your last question first, which is, okay, you can't afford a Bored Ape, you can't afford a mutant, you can't afford one of the kennel clubs to be in this community, but you do want exposure to this asset. How do you do that? There were already ways you could do that. There were apes that had been fractionalized. So they were put into sort of a vault and broken into a number of tokens, and you could buy those tokens. That's probably not the best way to play it. There were other vaults out there. NFTX is a website that does this, where you get a whole bunch of what are considered floor apes. So apes that have like the least desirable traits that are put into a vault. And then there's a token that if you put apes into the vault, you get some sort of NFTX ape token that has a liquid pool that trades on either Uniswap or SushiSwap, one of the decentralized exchanges. And then if you ever want to redeem it, you could buy back that token, go back to the vault, turn the token in, and take any ape out that you want. So there were already tokens that gave you fractionalized exposure to the NFT. These tokens aren't that necessarily. Like they don't give you any right. There's no arbitrage that should tie them to the value of the NFT. It's really a question of, are they going to be potentially used as like an in-game currency in the future for some Bored Ape game? Is it going to be used for other, maybe apes go to the metaverse somehow and you can use it to buy decentralized land? I don't know what it's going to be used for. People are really speculating. I'm sure Yuga Labs they're pretty good about putting out a roadmap. They may have had a roadmap on this already. But I think that's where a lot of like the speculative value of this comes from, is like, what part of the entire Yuga Labs ecosystem is this going to play in? Now, to your point, yes, people who own Bored Apes or Mutant Apes, what makes them a little unique and very different than CryptoPunks historically was that you own all the rights to that IP. So you could, for example, I could take my Mutant Ape, put it on a t-shirt and sell those t-shirts. I could license my Mutant Ape to Disney and create a cartoon out of it. The same was not true with CryptoPunks. You did not own the visual intellectual property to your CryptoPunk when you bought it. And so it was very limiting as to how you could potentially monetize that asset. And arguably one of the reasons why Bored Apes eventually overtook CryptoPunks in value was because they're actually monetizable. And there have been examples where, people have created bands that have been signed to labels where the band is a number of these Bored Apes and Mutant Apes. So, it sort of goes to the, I hate to say like traditional finance theory of discounted cash flow, but beyond just being a Veblen good, right? There is the ability to monetize these in some way. Last thing I want to add, by the way, just to be like clear, like when you talk about how much money was given to people, if you owned one Bored Ape, you got 10,000 of these ape tokens that are currently trading at $10 to $15. So at the current valuation, that is an airdrop of $100,000 to $150,000.
Man, like you said, like you. By the way, Jack, just your mic's definitely working now. I can hear you breathing.
Okay.
But like to your point, Corey, at least like Yuga Labs has done some interesting things. Like you said, if you bought an original Bored Ape, like you were then airdropped a Mutant Ape or the Serum or the Kennel Club, and now you're airdropped the ape token. So it's like they are adding value on their roadmap eventually. Like where does that value assume in the end? We don't know, but like at least there is a structure for like early adopters are getting airdropped value.
Yeah, absolutely. What I find very interesting about this value coming at this from like a traditional finance lens is, and we were talking about this a little bit before the show, is like this idea is sort of like getting paid a dividend. But unlike a traditional company where cash accrues on the balance sheet over time, the share price should go up by the amount of cash accruing. And then when that cash gets paid out, the share price should drop. This came out of nowhere. It was well speculated. They had on their roadmap Q1, there was going to be some sort of release of an ape token, but no one knew what the value was going to be. It's not like they said they pegged it to an ETH value or anything like that. And so what you saw immediately after the announcement was the floor price of Mutant Apes and Bored Apes went up by 15-20% each as people scrambled to buy them, because if you bought it, you were then entitled to claim the next day. And immediately after the claim started happening, the value of the Mutant Apes and Bored Apes dropped by 10 or 15%. So it's sort of like this surprise dividend that once it was claimed, that value left the asset, and the asset value fell by about as much as it was worth. So I estimated, for example, For a mutant ape, I probably got out between 7 to 8 or 9 ETH, if you sort of measure it in ETH. And that was about how much the floor value went up for mutant apes and then fell back down. So the market was surprisingly efficient here for a token that actually had no fixed value that it was supposed to have.
And Corey, what does the yield look like on that? How much is the floor for buying an ape that gets you the right to be airdropped ApeCoin tokens? And then also, can we compare that to TradFi? Like, I know there's a shipping company called Zim, the ticker ZIM, and the dividend date where you have to buy it by is, I think, like Monday or Tuesday, and then it pays it out on April 4th. That pays $17, and the stock's at 85%. So that's annualized, that's like a 80% yield. So what does the yield on the ApeCoin look like?
Yeah, so it depends on whether it's the Bored Ape or the Mutant Ape. So I know the Mutant Ape's a little better because I own one, but like right before this announcement, Mutant Apes were trading at about 17 ETH. And I'm going to quote everything in ETH instead of dollars because it's a little bit easier for me. So it's trading at 17 ETH right after the announcement, and the market's not perfectly efficient, right? Because information flow happens at different times. They jumped up to about 24 ETH, right? So, you're talking about an increase of 7 ETH. Got up to about maybe 25, 26 ETH. So 7 to 9 ETH is how much the floor moved up. That's how much the price moved up. And then you got airdropped something that, I've sort of monetized at this point for between 7 and 9 ETH, and it fell back down. So if you say the pre-value was, say, 24 and you got 7 to 9 out, I don't know, you're talking about 30%, a little over 30% yield, which is pretty nice. That just came out of nowhere. Right now, the values dropped back down. I don't know. You might say it was actually 17 and I took 7, 8 out. So maybe it was 50% because I'm exactly back to where I was prior to the announcement. And I've got this other, 7 and 9 ETH sitting in my pocket. So maybe you measure it as 50%. It's a very different model because it was a surprise announcement and this value was sort of created out of thin air, right? It's not like a company where they take their free cash flow, put it on the balance sheet. The price of the company has to go up as more of that cash is on the balance sheet, right? The stock is at least equal to that much cash, unless you think, the management is a bunch of psychopaths, but it should be at least equal to that much cash. And then when the cash is released, the price of the stock should go down by that much cash. But again, we know exactly because the shares are quoted in dollars, the dividend is in dollars. You know exactly how much it should fall by. When you've got Mutant Apes quoted in ETH, and then you're getting a certain amount of ApeCoin, and ApeCoin to ETH doesn't have a known conversion ratio at the announcement date. It's just pure speculation in the market as to how this is all going to price out. And it was really surprisingly efficient.
Man, I wish we all were in the same spot because Corey, you'd be definitely buying some nice vintage rum tonight after that nice 70th gain.
All right, so I just bought some nice rum. It's not vintage, but I just bought some nice Foursquare the other day. Man, I forgot how much I love Foursquare rum. Shout out to Foursquare, who's not a sponsor, but they should be.
Was it the Detente? Was the one you were drinking?
Yeah, the Detente. Yeah. For those who don't know, I really love rum. I'm also a bourbon guy, but rum for me is like, and I'm not talking like Captain Morgan. I feel like a lot of people drank really bad rum in college that gave rum a bad name. There's some really excellent, high quality rums that are very adjacent to bourbon.
I'm glad you got that in there. And speaking of like these surprises, right? Like you said about like, this idea of is basically a dividend surprise. With the other kind of surprise in essence we have this week, or certainty versus uncertainty, that I have to bring up is the idea from the FOMC meeting and then what happened to markets after, right? And we were just joking about when we got on here, all the hot takes that you get from traditional, finance media, after the Fed raises rates by, 25 bips, the markets take off 2% and maybe subsequently like another percent the next day. And then everybody's got these causal links of why like it's now risk on because the Fed or whatever, but like you and I know from the worlds we come from that, we are constantly talking about the options are, the tail that wags the dog. And the options market going into options expiration today, we're sitting on $2 trillion notional of SPX options, which is about 28% of the SPX market. And so if you're going into an FOMC meeting, even though everybody's guessing what that number is going to be, there's uncertainty there. So people are buying protection, they're buying put hedges, right? And then the dealers have to hedge out that risk. And as soon as the FOMC meeting happens, you go from uncertainty to certainty. So then volatility collapse, those deltas go down to zero. The market makers now need to rehedge the books, meaning they're buying deltas, and that spikes the price 2%, on Wednesday, and then subsequently going into Thursday. But everybody thinks there's like these different causal links. Like all of a sudden, retail investors decided it was risk on. When you have $2 trillion worth of options moving through options expiration with an FOMC meeting 2 days before options expiration, and we see that delta collapse over the last 2 days. And I just kind of went on just a tangent there, but Corey, I don't know if you have any different thoughts on that or how you think about it.
It really reminds me of a conversation I had with our joint friend, Jem Carson. I had him on my podcast last year, and he was talking about how a lot of like our very traditional, what's the word I want to use? Phrases in finance actually come from effects in the derivatives market. That's his view, at least. So right. Buy the rumor, sell the news. And I think what you see with event risk in particular is people will buy hedges for an event. And that hedge, people think about buying a put option as a hedge to downside market risk. That hedge is actually an expression of a trade. Just because you're not putting on a short when you buy a put doesn't mean that the person who you bought the put from isn't going to actually put that short on for you to hedge out their risk. And I think if you think of it that way and say, well, everyone was buying all of these puts, there was a huge amount of puts that were bought because of this event risk, because nobody knew how the market was going to respond. And then the event happens and people either start taking off their puts, monetizing them or just selling them, or they're going to let them expire in the next couple of days. Well, what that effectively means is that all those implicit shorts that happened are now bought back. And that's a huge amount of potential demand that can drive the market price up. And so, I think there's this really interesting dynamic of we always want to ascribe sort of a nice narrative to what's going on. It's a lot more fun to talk about macroeconomic reasons or try to find a they, other than there's just some potentially technical flow factors that are driving the market day to day. And it doesn't mean that over the long run, there isn't sort of this weighing machine that happens that okay, collectively, the market decided that wasn't a bad meeting. They didn't need to replace their hedges. There is still potentially that catalyst of purpose in what they're doing. But in not replacing their hedges, that inaction is in of itself an action, because it means all their hedges are going to burn off, which is an implicit repurchase all the shorts. And so it's a long way of saying what happened this week doesn't necessarily mean the market can't go down next week. It doesn't necessarily mean there's a big return of, retail buyers. It might just be, hey, a bunch of institutions had a hedge on because this market's crazy and things ended up playing out a little more dovishly than expected. And so they don't feel the need to put on, another big round of hedges in the meantime.
And just because you have this positive dealer gamma that's basically buffering the market, creating a form of mean reversion, it doesn't mean we can't break outside of that. If you have an exogenous event and all hell breaks loose, it doesn't guarantee that it's going to keep the market constrained. Anything can technically happen. And then, you said, after this, we go through expiry today and everything. Next week, these are always interesting, right? Because people are going to reestablish positions, so you don't have quite the same, that $2 trillion notional is not on the books anymore. So there's always this kind of up in the air. There's this palpable energy in the air to me whenever we go into this next week, especially after a triple witching, quarterly expiration.
Well, there's a lot of discussion over the last couple of years about how just notional option volume went way up, right? That retail catalyst of buying the YOLO call options of 2020 and 2021. You've definitely seen a decline of that type of behavior, but you did see a big pickup, a material pickup in put option purchases, right? And so to your point, as the market started to drift lower, we went from this zone where option dealers were behaving in a mean reverting fashion, where every time the market went up, they were hedging by selling the market a little bit. Every time the market went down, they were buying back, sort of pinning the market, into this zone where they actually had to hedge their puts. So every time the market fell, they were selling, and every time the market rallied, they were buying. And so that sort of exacerbates these market movements. One of the potential reasons we saw a lot higher vol over the last couple of weeks was we were stuck in that zone. We have actually today, depending on whose model you follow, cleared back into that mean reverting behavior, which could bring some stability to the markets. But again, the total notional gamma that they're hedging is going to be significantly lower post-expiry than it was 2 weeks ago. And it'll be very interesting to see who decides to roll their puts today and what they're rolling them to. So, but again, if a lot of people were buying for that event risk, it sort of is going to take a while to see how they interpret what the Fed said, what it means for sort of, April, May, how they think the Fed is going to necessarily roll off their balance sheet, how the Fed is going to hike at their next meetings, and that could dictate their positioning, which could invite a whole new round of shorts.
And so we're talking about, delta, gamma, our Greeks and everything. And I'm going to ask you a two-part question just to be annoying because I hate two-part questions. It's like you had a tweet this week about just like buying a house, which was probably an innocuous tweet that you thought you were throwing out. That was just a random tweet. And
that was...
so the first part of the question is like, how funny is it? Like sometimes you think what tweets you're going to think are going to catch fire and which ones aren't. And it's usually the ones that don't. And then the second part of that, I brought up, delta, gamma, et cetera, because part of your tweet was about convexity. And you said what you actually learned from a tweet about housing is that most people don't know what convexity is or convex instruments are. So let's discuss.
Yeah, I'm actually gonna set this up and just flip it back at you because I've talked enough already. So here's the situation. I currently live in Grand Cayman. My wife and I moved here during COVID. It was a pure COVID escape situation. This is not a lifetime move. We're planning on moving back to the States. We won't be moving back until later this year, and we probably are going to want to buy a house eventually. I've already been a homeowner. Please don't talk to me about Finance 101 home ownership. I owned a house for nearly a decade already. I know all that stuff. But we're looking to potentially buy a house. We're going to want to move to an area in about 6 to 9 months. We're going to want a year in that area until we figure out what neighborhood we want to buy, if we want to buy at all. And then we're going to look to buy. So I'm talking about buying a house like 18 to 24 months from now. And I'm thinking to myself, there's really two big risks I see. One, the supply crunch in housing doesn't get fixed. Inflation continues to run high. Materials continue to run high, and housing prices escape the pace at which the rest of my invested assets appreciate. Or two, the cost of a mortgage goes up dramatically. And from a payment perspective, you see your monthly spend goes up, but combined with supply constraints and all sorts of other issues, housing prices doesn't fall as much as it should, repricing on those higher mortgages. Both of our potential risks, and they're different risks. So what I was looking for was saying, I know I want to be a buyer potentially in 18 to 24 months. What would be an interesting way for me to hedge my position? And ideally, that hedge would be as convex as possible. So let me flip it to you. Why don't you explain what you think I mean by as convex as possible, and maybe talk about some interesting ideas you would have that I should consider.
Because I'm like the noob. Could I be the one to explain convex? Because I feel like Jason, you're going to give a definition of convex that's like correct.
Jack, are you? Well, I was going to say, Jack, are you going to give an actual correct definition of convex? I asked a bunch of people and they gave me incorrect definitions. So
okay, I don't. This is my sense of convexity, and I don't think that I'm necessarily correct. But it's something something that is non-linear and pays out a lot. So it's not for every dollar that, if it goes up $1, you make $1. If it goes down $1, you make $1. It's not like owning a stock or shorting a stock. It's once it approaches a certain level, you make a ton of money. So like the ultimate, I guess, convexity position would be a variance swap where like if the if the VIX is at, if you sell I guess variance swap at like 15 and the VIX goes to 90, that's what 9? No, that's what 6 times. You'd be 36. You 36x your money. That's very convex. It's not like, oh, I shorted one contract of SPY, like I'm hedged. No, like convexity is buying a put option at like the simplified products of owning like 50% out of the money put options. Like that's pretty convex.
Yeah, that's not bad. Like I think you're just talking about, like you said, linear versus convex, right? If you have a linear instrument just going up 1-for-1 over time, and there's velocity or acceleration to convexity. So that's when you get like the hockey stick like effects. It has an exponential growth curve versus a linear growth curve. So there's very few instruments that have convexity. So I think that's what Corey was alluding to, and that's why he was asking for convex instruments. I was laughing hysterically as he was recounting what happened on Twitter, because to me it looked like 80% of the responses were like finance 101, and everybody thinks you're a moron, basically, right?
Yes. Well, that's par for my life. Everyone thinks I'm a moron. But yeah, so that it's not a bad definition. I mean, of convexity, Jack. I think I often just say to people, look, like upside convexity, a very simple example would be something like a lottery ticket. You pay a small premium, and if you win, you make a tremendous amount of money. It doesn't mean the expected value has to be positive. You could expect to lose money. It's just that under certain scenarios, you make obscenely amount more than you paid. That is highly convex. On the downside, it would be something like insurance. You pay an annual premium for car insurance or health insurance, and then if you need to tap into it, typically the claim is significantly larger than the premium paid. That would be like a put option. And so to me, what I was looking for was that asymmetry, right? I wanted something I could, if the house, and this is not saying this is the number, but like, let's say I want to spend $1 million on a house and I had, $200,000 to put down. Well, was there a way for me to take $20,000 and buy a hedge such that if the house I wanted went from $1 million to $2 million, that 20,000 could turn into 200,000. The house went up 100%, hedge went up way more.
Yeah. And let's talk about it in two steps. One, like we'll talk about what potential convex hedges are, but let's talk about real estate in general, because it's one of my favorite topics, and this is why you and I want to talk about this a lot. It's like, my family's been in real estate ever since I was born. In a past life, I was a commercial real estate developer, and my partner Taylor and I were talking about this a while back when he was looking to buy a house in Austin, and he actually wanted to create a collar, like, because he actually didn't care about the upside appreciation. He wanted to hedge his downside, and he was like, well, I'm gonna live here forever. I just want to make the mortgage payment for 30 years and not worry about the exogenous price appreciation or depreciation. And so we were going through this exercise, and there's not a lot of options for you, right? That's the problem, is like single family residential has a lot of granularity issues. It has regional issues. It has local issues. So there's a lot of ways, like we don't have like perfect indexes. And I know some people suggested to you there's, regional housing indexes and everything, but those they're not very liquid. They don't have an options market, which when we get to convexity, you'd be looking for options on those markets. You can have other things, like there's all sorts of interesting new products out there, like companies like Divvy and stuff, where basically you can do, now it's a way to do lease to own, where you own a bit of equity in the property. So maybe you could ride one of those for 2 years, take any sort of appreciation out of that, and that will hedge some of that appreciation risk for you. But once again, not convex. It's going to be a simple way of looking at it. Obviously, you could go out and buy call options on home builders. I don't want to dox you, but like just wherever you're going to, like the general, town area you're going to live in, like who's a publicly traded home builder there? Is it Toll Brothers? Is it Lennar? Is there a way to buy, maybe call options on those builders? Now, granted, that's not going to be a perfect hedge either. Everything we're going to talk about is going to have
going to be basis risk,
basis risk all across the board. And so you have to worry about the operations, obviously, of that home builder as well. So the other ones you brought up too that are interesting are the idea of a supply chain, right? Whether it's lumber, steel, nails, rebar, even the footings for the joinery. Like there's ways where maybe you could use like a CTA trend following model, and there you can get some convexity. But I love bringing this up because I know you and I have argued with people in the past. Are CTAs long gamma or long convexity? I mean, they have a P&L that looks like a long straddle or long strangle, but historically they used to add to the positions when they went in their favor. They no longer do that. So then you're taking back some of that convexity or gamma because you're not getting that acceleration or that velocity. But you could get an asymmetric payout if you were long like lumber or steel. So that's one way of looking at it.
Yeah, I mean, you could, all right, to that CTA point, you're not getting the same gamma effects. They're not increasing their position size as the price goes up anymore. It's often a little more binary. But that said, they will take the position size off, so it's not linear, right? If lumber starts to go down, you can take your capital back, and then if lumber starts to go up, you can put that margin capital in and get the leverage to the upside. So it is a little asymmetric. I saw a comment here, right? The other side of this equation is the cost of mortgages go up. So you could do something like puts on 30 years, which is an interesting play. You could go I guess you could go into the OTC market. I mean, I'm not going to the OTC market. I don't have an ISDA, but there's certain ways in which you could go into the OTC market and do like payer swaptions, I guess, which are probably way too complex to talk about here. But like, okay, so let's talk about puts on
TLT.
30-year. Yeah, puts on TLT is probably.
But like you said, you could do that stuff. Like that's what we're saying is like if you had an ISDA contract, you can do all sorts of crazy stuff. So we were talking about the supply chain side and the supply chain disruptions and that increasing your housing prices. And then you're just talking like how do rates affect housing prices? Now, once again, we said basis risk everywhere, and I just don't think it's proximate, but it's not proximate, right? Allegedly, as 30-year mortgage rates go up, housing prices should come down. If it were that simple, right? If it was a mechanistic process. So that would be a way where you could get convexity, especially if you were you took on a position size and you added that position as it went in your favor, like you were just talking about. There's a way to play that on rates or on a 30-year bond, right? And you have a lot of convexity there. Like people don't realize, like even if a 30-year bond's trading at 3% and rates go down to 0, based on your DV01, you're going to basically double the value. Like, people like we're like, we don't have much room to move if we're at 3%, but like there's a lot of convexity there.
Especially if you're in options. Jason, can you explain, or Corey, can you explain what basis risk is and what you mean by that?
It's just a industry term for saying like correlation risk.
Yeah.
I don't know why we don't say correlation risk instead of basis risk. But when you say something as basis risk, you're basically saying it's not a perfect match one for one. Like, I might buy a call option on home builders, and the home builder might go out of business for something that has nothing to do with property values going up. Might have property values go through the roof, and my home builder, my call option is worth nothing. Like the hedge was supposed to be correlated, but I'm taking on risk that these two assets aren't actually going to track each other. That difference is called a basis, and so it's called basis risk.
Almost everything we do doesn't have a perfect match off. That's the problem, right? Whenever you go to hedge risk, you're not going to have that perfect exact proxy for what you're trying to hedge. So like just a crude example would be like fruit, right? Like if you want to hedge fruit, like apples and oranges are very different, but you could go long apples and short oranges, but then you have basis risk, right? If the spread blows out. So that's what I'm saying. You never have a perfect hedge. And so when I was bringing up, like let's say the 30-year treasury or whatever is like, if, ceteris paribus, based on the textbook, if rates go up, housing prices should come down because mortgage rates should go up. And once again, your monthly payment should rise, and therefore the nominal value of homes should come down. But like, for example, take the late 70s, early 80s. I don't believe in the Volcker great man theory. I don't at all. And so Volcker might have actually just screwed the baby boomers because you had such a pig in the python moment where baby boomers needed to buy houses so badly. It didn't matter how bad he jacked up rates. The demand for housing was so huge, they were going to flow through there anyway. So even if rates do go up, you would think housing prices would come down. But if millennials like Corey, if it's a pig in the python, they're buying the houses no matter what, that's the basis risk, where that basis kind of blows out there, Jack, where it's like, it wasn't a proximate cause based on textbook because there's other exogenous factors that are going to be, kind of throwing off that exact proximate basis risk.
You want to know what my favorite answer was of all the tweets? This one was genius. This was the most convex trade. Well, it depends on how you view the downside. But this person basically goes, no, you don't want to you don't want to think about this through the lens of like, how do you hedge housing prices increasing? You want to think about how you can make housing prices go down. What you should really do is just buy a gun and every once in a while walk through the neighborhood you want to buy in and just shoot into the ground. That'll keep housing prices down. I was like,
oh my God.
I was like, that's a pretty convex trade when you think about it.
Well, that's very, and you're short convexity because you could end up in jail.
Well, yeah, that one could go against you pretty bad.
That's what we call basis risk. But then the other one, Corey, the other one where you can play it a lot, where there are indexes, there's ETFs that you could buy options on, is there's a lot of REITs or real estate ones, whether it's Vanguard's VNQ and everything. But now we're, once again, basis risk because we're talking about commercial real estate. So you could buy calls on that. But like if office space and other REITs and different form of commercial real estate goes down while residential still continues in your local geographic area, then you have massive basis risks there too. I mean, but you could buy convexity there. So we're talking around it in circles, but like there is basis risk, there's some convexity, once again, there is not a proximate hedge for residential local real estate. I guess
what about mortgage REITs?
There's an interesting one. It's that you could buy in the local area in a hyper levered fashion.
Yep.
Right. As long as you're willing to default. Right.
Yeah.
The problem
was
is
my
you got
next
this massively illiquid asset. Well, potentially illiquid asset. And it's an asset that there's a lot of bid-ask spread to, right? You're paying 5% in, 5% out, sort of situation. And so, if you can get a ton of leverage to buy, and housing prices, it's still basis risk. The house you want to buy might appreciate differently than the house you have, but if housing prices double, great, you got a levered double. That's really good. But if housing prices goes down, well, you're levered to the downside, so you need to default, and I can't default. So
it'd be hard to buy that house in 2 years if you defaulted. But yeah, that was my next suggestion, is like when I do a high LTV single family residential rental, and that's your proximate. But then you got a lot of headaches.
Right, so here's a
over
question.
2 years.
Here's a question: could you set up an LLC and claim it as a business, buy a levered residential real estate position, and then just have the LLC default?
Yeah, but you're still going to be on the hook personally. That's the LLC for putting, especially in single family residential, is just a slight hurdle for you getting sued for anybody breaking their neck on the property. Like it's not like you can't get.
This is why I don't do real estate.
Yeah, you're still gonna have the personal guarantee. Like there's not going to be necessarily a way around that, unless unless you're willing to come to the table with a lot more cash and everything. But then that defeats the whole purpose of having.
I guess that's why everyone would just buy their house in an LLC.
Right. Exactly. I started trying to think. So that was one, is like, but once again, why would you want the headache of then running a single family rental while you're waiting those 2 years and like house hacking your way there? The other ones, I started trying to think, okay, let's go a little bit more outside the box. Maybe a title company in that area. If you could buy into that title company, or is it publicly traded? Because if that, real estate keeps a pace, obviously the title company is doing a much more brisk business. And then starting thinking secondary and tertiary effects are like, if that market keeps going red hot, people are much more likely to take out HELOCs, home equity lines of credit, right? And where are they going to spend that disposable income? Maybe we're talking about your favorite love of luxury watches. Maybe it's luxury cars. So maybe taking a lot of basis risk, maybe buying some of your Rolexes and Breitlings in your local area. I mean, that may be a proximate hedge.
By the way, so this is a total tangent, but this is how the show works now. I thought it was fascinating. I didn't realize that Rolex watches have continued to go up in value this year at an accelerated pace. Like if you look at a Rolex Daytona, it was maybe 35,000 on the gray market last year. It's now like 60, and a lot of that appreciation happened in Q1 and December last year, versus like you look at a lot of other speculative assets that were getting pretty hot, and I don't know, Pokemon cards have fallen off entirely. I find it very interesting that like you had this huge weird asset bubble that you and I talked about last year on the previous episodes of Pirates of Finance, and like now some of those have fallen off. Others have started accelerating. I was talking to someone about whiskey, and what you've seen is like Scotch is now so outpriced, bourbon's so outpriced that you're now starting to see high-end rum starting to price up in bidding wars. So yeah, it's weird to me that you had the market fall off, you had crypto fall off, and what are you laughing at, Jack? Turn your mic off. Jesus. You had crypto fall off, you had equity markets fall off, and yet things like a Rolex still continue to appreciate dramatically.
Two other things on that.
About markets. Give me your macro view.
One, we should talk offline, because I've told you before, I know authorized dealers in Cayman that you can get those retail prices on Rolex, and maybe we need to have you load up on quite the shipment before you come to Florida, and then we can.
They don't have them anymore.
Let me see what I could do. The second one was, oh man, I totally lost my train of thought.
Why is my Pokemon card collection lost tremendous value, Jason?
That's on you. Pokemon is way beyond my area of expertise.
To be clear, everyone, I do not own any Pokemon cards.
Wait, so I got two ideas for hedges, unless it comes back to you, Jason.
Go ahead while I think of it.
I think you could maybe buy a strangle on TLT, because it hedges interest rates going up a ton, which would cause mortgage rates to go up a ton, making accessing housing less affordable. And then it would also hedge a huge rally in long-term rates, which presumably would happen when the economy tanks, when real estate would. That's kind of a vanilla type. I think the most direct way maybe would be going long calls on residential REITs and long puts on mortgage REITs because mortgage REITs basically borrow money to invest in trust, so they make money when they make money when spreads are low, but when they rise they lose money, so you want to buy puts on them. I think I got that right.
Yeah, they're what? Borrowing short
To buy mortgages.
to buying long. Yeah.
The other
no,
ones
I actually like all those. I thought so. The TLT one's interesting, right? Because there's this, to go back to something we talked about last week, it's destination versus path. Like you can have this situation where the market could start to fall apart, rates could collapse, and then mortgage rates could go down, and then you could have the Fed inject liquidity into the system again, and then you could have people refining like crazy, another housing boom, and by the time 2 years comes, again, prices are higher, even though in the interim rates went way down. So you could, I agree with you, Jack, buying both a put and a call on long dated was something that was definitely very interesting to me. And the other one that was mentioned, sorry to cut you off, Jason, but like I feel like you mentioned this, Jason, which was like go around to people in the neighborhood you want to buy from and like basically sell a call or have them sell you a call. Like, you know, you pay them a premium and say, I'm willing to buy at this price in 2 years. You know, pay them 25, 50 grand each. And then if it's a house you like and you agree on the price today, then you're sort of protected for the next 2 years.
Huge counterparty risk, though, is that
and you have to be willing to take them to court over it.
Yeah.
Well, yeah.
That's an adverse selection issue too. It's like, they know the house, they know the area.
And not only that, it's like, and by the way, shout out to our buddy Chris Abdelmasia. It was actually, he was talking to one about that, and it's like, good luck. Go around the neighborhood you're in now, knock on doors, see if somebody's willing to say, explain to them what you just tried to explain.
It wasn't just Chris. I had 4 or 5 people recommend that. Now maybe they were just parroting Chris, but I was like, why does this seem so common? Like, that would never work.
So the other things you could do, you know, we're thinking about this discretionary spending, whether it's watches, if you're going to Florida, maybe boats, right? Maybe collector's boats or something is a way to get a leverage position into a boat. The other one always is like, and I know kind of where you're looking is like, you can get these like these new projects like ultra modern condos that are going up and get pre-construction pricing where you only have to put like 3 to 5% down, and it's not going to be built over the next 2-year period. And depending on the way the contract's structured, a lot of times you can flip out that contract, so you get a very levered position. So if like you're buying, you know, $1 million condo, they want $30,000 down. 2 years from now, it's worth 1.3. You can flip out that contract and take, you know, $250,000 off the table there, and then you have a nice that's probably the best convex way of doing it.
Right. And then I hadn't considered that.
And then you have to look at the contract structure, but then if there's default risk, like you just lose your deposit. So like if it's structured properly, like that's there's not a lot of risk there.
So
the other one,
but there's a comment here. There's a comment here from someone who's saying, I don't know, real estate right now.
I was going to get to that.
Again, I'm not buying real estate right now. No, nor is this a recommendation that whether you should or shouldn't. I am in a point in my life that I will likely be looking to buy real estate for non-financial reasons in 2 years. So I'm just trying to hedge that.
Yeah, and your demand for housing to buy a house is inelastic. It's you want a house. It's not because you.
Well, having owned a house, I don't know if I want a house.
Exactly. You might want to do the math on that. So there's a couple of things. One is, you know, we brought it up earlier, like lease to own. In hot markets, it's hard to get lease to own, get people to agree to it. But that's another way. Basically, a land contract lease to own is basically you're putting up a small deposit, you're paying a higher rent multiple that's also going towards that down payment, but you're agreeing to the price 2 years from now. Or maybe you can agree on percentage escalators in the price. So that's another way for you to get a convex hedge. But when markets are hot, it's hard to get somebody to agree to lease to own when people are coming in overbidding on cash offers. So that's one way. But going into real estate now, look, I've been in and around real estate for over 4 decades. I cannot predict real estate prices.
Jason, how old are you?
I'm like 82.
I was like, you're the youngest like 70-year-old I know. I've been doing this for 40 years.
Well, like I mean, ever since I was a baby, I've been living in flipped houses, like living on construction sites. So that's what I'm saying. I've been around this like my entire life.
In your presentation decks, do you have like cumulative like our team has experience. 800 years of cumulative experience in these markets?
Those are my favorite as always. So then the question is, though, okay, that you brought in another question that I was almost asking you privately. We were talking about a little bit is like, what is the plan for this house, right? Like we also have to be rational. And what's interesting is like, your average 30-year mortgage, the first 7 to 8 years, you're paying interest only. So you're just paying the bank interest, right? You're not paying down any of the principal unless you change the structure of that mortgage or you overpay. And then the second is just years ago, the average person spent only 7 to 8 years in their home. And that's actually come down. It's like 5 to 6 years. So you're essentially just renting from the bank and paying interest only for the time you're going to live in the house. So people being delusional about this is the house they're going to live in the next 30 years and pay down that mortgage, especially when you're looking at family formation, et cetera, and you just don't know. It's like, it's a really interesting conundrum. Like, do you really need to buy a house? And then what are the other uses for that capital?
Yeah, this is the one. And I think if you do the math on housing, it gets a little harder, right? Because and it really depends on how much leverage you want to take,
Exactly.
what the opportunity cost of that capital is, the benefits, and I think there are benefits of illiquidity. Sometimes it can prevent you from doing dumb things with your money. But part of it is, and this is something I still need to explore, is I don't necessarily think financially it makes sense for me to buy a house, but I don't know whether I can rent a house that I would want to live in. Like the houses that I would be potentially looking to buy, I don't know if there are actual rentals out there where I'm looking to buy and in the price range I'm looking to buy, right? So you have a supply issue potentially on the rental side. Condos, absolutely. I at this point, I think the math completely makes sense for me to just spend my life renting condos. But when you start talking about 4 or 5 bedroom houses, they're harder to find. Doesn't say they're impossible. And then the other side is, right, just from a lifestyle perspective, if I decide I want to be somewhere for 20 years, do I want to be renting for 20 years and have to move between houses, or is it I want that like permanent base? These are all just lifestyle decisions there's a different utility to the cash. So they're all open questions.
Yeah, I think you nailed all of it. It's like it's a leverage play, so that's one way to look at it. It's a forced illiquid savings plan to pay down the mortgage over time and have an actual savings account, which everybody loves. But it doesn't make economic sense. But not everything in life makes economic sense. Like you said, you and your wife have good taste, so you might not be able to find the house you want. And if your wife wants a home,
good taste.
Right?
My taste is questionable.
I was thinking about this the other day when you're just joking about my age. Like, I'm 43, never been married. But if I'm not saving up for a wedding ring, I'm an idiot just based on probabilities. Right. And so just to think like your wife and you want to have kids, like you're going to buy a house, whether it makes economic sense or not. Like you just kind of have to accept reality and probabilities of life.
Call options on GDX for the ring. That's
what did you say? GDX? Oh.
Yeah, for the gold miners ETF, you got to hedge the ring cost. So.
You just have to find a partner that doesn't want an expensive ring. That's the real answer. Jack, what were the 3 topics today? By the way, it may turn out that the best hedge to my housing conundrum might be my mutant ape, to really bring it full circle.
Yeah.
Just with the airdrops I'm getting. Yeah. Halvesies. Man, do we have time to go into halvesies?
Up to you. You guys are the pirates. I'm the boatswain. Up to you.
Let's start talking about halvesies, and honestly, it'll probably be a reoccurring theme for you and I.
Yeah.
Throughout it all.
Okay, let's tee this up with halvesies is the dumbest sounding investment concept that I think is one of the soundest investment concepts there is, from portfolio construction to trade structuring to timing decisions. Halvesies just really is an unbelievable tool and utility that I think people often overlook in a world where choices often are seen as black or white, right or wrong. Halvesies can save you a lot of, sort of consternation. So Jason, why don't you take it from there? Your interpretation of halvesies.
I'll give an example. Maybe that'll be helpful too. Is like, so a lot of times we talk about portfolio construction, and let's say you used like a Harry Brown permanent portfolio that was a quarter each stocks, bonds, gold, and cash, right? And it has a fixed weight buckets that you rebalance either on a time basis or on a rebalancing band basis. So by having buy and hold, you have pros and cons to that, right? And then so other people come to the table and they say, well, I'm going to use a risk parity model that's going to target volatility. So I'm going to kind of almost trend follow or trade in and out of that, right? So you're almost overlaying a form of trend following with a form of buy and hold. And so sometimes our response is that people are like, what should I do? Should I go, trend following and volatility targeting, or should I do buy and hold? And we go halvesies, do half each, because at one point, one of them is going to get hurt and the other is going to do well, and vice versa. Because you're going to, in a March 2020, you're going to have those whipsaw effects of targeting vol or trend following. that you're not going to have the commensurate problems because you're just going to be rebalancing the buy and hold that you would with permanent portfolio. So a lot of times when, then you and I were talking about like intimacies of trade construction on maybe, rolling your options and or like hedging your deltas. And it's like, how much should I hedge? Sometimes it's half the position. And so even though, like you said, it sounds ridiculous to say halvesies, a lot of times it's the most prudent way to not have hubris to like over optimize a lot of strategies, because especially you coming from quant land, like you're just, it's just writ large with just over optimizations. So sometimes it's a form of mental check or a check on hubris to use a dumbed down structure of almost halvesies to make sure you're not over optimizing any sort of scenario.
Yeah, I think that's spot on. I mean, just to be clear, what does halvesy mean? It means split things in half. So a real life example for me was, we were talking about rolling options earlier. There were some options that I had to roll, and I was trying to figure out when I wanted to roll them. And to me, there's a lot of event risk, right? There was last weekend when markets are closed, there was still a lot of issues with Russia, Ukraine that could materialize over the weekend. Rolling my options was going to change the type of protection I had. You had the FOMC meeting. That was going to change the type of protection I had if I rolled before or after. So to me, the answer becomes, well, if I roll before, I risk having less protection, but I might do it at a more attractive vol level. If I roll after, I might have, the opposite situation. You don't know how these things are going to play. So maybe the answer is I do half before, half after. One of the things I was looking at was in structuring. I was looking to buy some puts, but I thought that vol was really high right now, really elevated. I thought there was some event risk. I think skew is really steep right now. And so if the market rallies, you risk those puts losing a ton of value. You're paying a ton of potential theta. So I said, there's some really attractive things about a put spread right now. But the problem with the put spread is that I was going to get less protection for the event that I was trying to protect against. What do? Well, maybe I just consider halvesies. Maybe I do half the trade with the put I wanted to buy, and I do half the trade with a put spread. And so I'm never in the real position of like being in one conditional path where I blow everything up and I take too much sort of path risk. Now, I have to say, if you like halvesies yourself to death on everything, it's like just over diversification of like assets, time, structure, and you end up so well diversified, you end up paying just like an enormous fee to get the risk-free rate, right? So you can't you have to take risks somewhere to earn a reward in theory. But for certain situations, again, I think I get asked this all the time in my Twitter DMs, as I know you do, Jason. It's like you're presented with an option, and it's always, what should I do? Should I take the first door or should I take the second door? And it's like in markets, you don't have to do that. Like these are fungible decisions. You can split it over time. You can split it between position types or structures. You can split it between assets. All of that can be split. That's one of the wonderful things. You can take the middle ground. And often the middle ground is like the more stable, safe ground for long-term compounding.
Yeah, and I just want to point out, it's even though it sounds like kind of idiot saying halvesies, there's a ton of academic literature around this. But then, like you said, there's also the trade-off of trade costs. So even if you could incrementally tranche everything out to the infinitesimal degree, you have trade costs. So there's a balance there between trade costs, which is also why sometimes it's halvesies. And this is a shout out to you. I mean, years ago, we got to know each other from your papers on rebalancing timing luck, right? And that's not just halvesies, that's maybe quartersies. Or, if you rebalance weekly instead of monthly, you're avoiding that once a month rebalancing or quarterly rebalancing where you have timing luck. And so it's a form of like of lack of hubris, right? It's a form of saying I'm not certain, so maybe I should tranche out my timing mechanisms or tranche out my percentage I'm going to rebalance to smooth out my P&L, like we said, minus trade costs. But it's a way of being a little more agnostic to the markets and realize you're never going to be perfect. And so you maybe want to use a structure that's the least shitty, that will at least help smooth that P&L over time.
I'm laughing and looking to the right, by the way, because my wife is trying so hard to be quiet. And she's like opening the refrigerator and playing in the ice, trying to get ice for a drink. This is what happens when you work from home, folks.
Yeah. Well, I think this is why.
But to your point, like I think a lot of people don't even consider right, halvesies doesn't sound sophisticated, right? And I think a lot of like the heuristics we use in investing aren't necessarily sophisticated, but when you go overly sophisticated, you're optimizing a decision in a field that has a huge degree of uncertainty. And so something like halvesies is actually often very robust to that uncertainty. And again, you're never going to make the hero trade, but you're also going to never make the zero trade. And it's more important to not make the zero trade, because if you make the zero trade, you're out of business. There's no coming back from that, right? And I think that's the piece that people often don't understand, is like smaller continuous compounding is more powerful over the long run than like that one big, grand slam trade.
Man, I haven't heard you say that way before, but like the hero trade versus zero trade, like nothing could be more endemic of the way you and I think about markets in the world. Is like surviving is the only success. And so everybody's always asking us these, like you said, binary questions like, what's the hero trade? What exactly should I do here? What's my best trade? And that's not the way we think about markets at all. Like that's how you make zero trades, is because you're trying to be that hero. You got to think about diversification, survivorship bias. How do you just stay in the game? That's the entire point to all this. And then Jack, if you're still there, probably in the background, I was just thinking like CTAs this week, call to action. Like, are we putting this out on audio now? So the people that don't looking at Corey's beautiful face, they'd rather listen to my hoarse terrible voice over audio. Is this are we putting this out on a podcast form now on Blockworks?
We will be shortly. I think it's still under review from Apple and Spotify, but we will be shortly. So yeah. By next week, you will be able to subscribe to this in podcast format. Today, we are on YouTube, so as you can see in the banner below, do not forget to subscribe. My just quick take on halvesies is, well, from Corey, when you say, Corey, by the way, you're muted. You probably know that. Is that when you say...
Again, my wife's making lunch.
Yeah, got you. when you say, halvesies doesn't actually sound that sophisticated, it doesn't sound sophisticated because you're calling it halvesies, number one. But for some viewers who may be more familiar with the world of poker than the world of quantitative finance, let's say you have pocket queen, I have pocket queens, and Corey, Jason, you raise, I 3-bet, I re-raise, Corey, you 4-bet, or actually no, so I 4-bet and Corey, you 5-bet me. Like, you probably have aces or kings, but queens is a pretty good hand. Like, should I fold or should I call? Like, a poker theory.
Is this what it sounds like when I talk? Like, I have no idea what you just said.
Poker. If you're getting shoved all in on and you have queens, like you should play it halvesies.
I like that you just doubled down on the jargon. If you're getting shoved all in on, I'm like, I don't understand. You're like, okay, but if you're getting shoved all in on.
Yeah. So I think halvesies makes a lot of sense, and there is a quantitative approach to poker that I'm not a quant when it comes to poker, but like I've seen people's analysis that it's similar level of rigor that would suggest actually, yeah, you should play halvesies in poker too. And I would not at all be surprised that there are other aspects of life beyond just investing and poker where halvesies would be a good strategy.
It sounds to me like, Jack, what you're saying. Sorry to cut you off, Jason. It sounds to me like what you're saying, Jack, is you have a very good hand. Someone else is betting like they have a better hand, but they could be bluffing. So you could bet too much because you have a good hand and they actually end up having a better hand, in which case you're wiped out. Or you go, I've got a really good hand. They're betting like they have a better hand. I think they're bluffing. I'm going to probability weight. Maybe I go halvesies on the bet I'd really like to take. I maybe didn't maximize the value of playing this great hand, but I also didn't end up with the zero trade. Is that like my correct interpretation?
You corrected it. You so much clearer than mine. Yeah, you nailed it.
Take me to Vegas, baby.
Corey, it's after the river. When you have the nuts, then you're gonna go all in. Like, I have no idea what Jack was talking about either. The poker jargon's beyond me as well. But I wonder if you put your big brain Carnegie Mellon hat on. I think that Jack has a point. What's a sophisticated way of saying halvesies? Give me the quant definition.
I don't know if there is a quant definition of halvesies.
We got to think of one. That's what I'm saying. We write a paper. That's your next. We're co-authoring a paper now on halvesies, but we're going to
halvesies.
But we're going to come up
with mathematical
like,
elegance of halvesies.
But we have to have some obscure financial jargon to make it sound like it's so obtuse that must be brilliant, even though it's really just halvesies.
I'm sure there's a way that we could write a paper that is obtuse and brilliant sounding that gets us published, but really just says split your money 50-50.
Exactly.
Definitely possible. All right,
cool.
I think we're over the hour here. This has been fun. Shout out to Blockworks. Don't forget to like and subscribe. If it's your first time checking us out, thanks for tuning in. If you're tuning in after the live show, feel free to catch us on a live show where we can see the questions. We love responding to them. We appreciate everyone showing up. If you're listening to this on a Friday, enjoy your weekend. If you're listening to this some other time, thanks for tuning in.